All right, let's get right into it. We're all taught to watch company earnings, sales, the fundamentals. But what if I told you there's a much bigger, almost invisible force out there? Something that acts like gravity on the entire stock market. A force that, when it pulls back, can trigger a bear market even when most companies seem to be doing just fine. That force is quantitative tightening.
So first, let's talk about what we all learn on day one, the golden rule of investing, right? Find a good company, one that's growing, and your money will grow right along with it. This is the story we're all told, and honestly, a lot of the time, it's true.
And this idea, it's powerful. The conventional wisdom is that even in the absolute darkest of times, think about the 2008 financial crisis. A company that's truly strong, that has real demand for its products, well, the market will reward it. It's a comforting thought, and it makes perfect, logical sense.
And hey, this isn't just theory. We've got real-world examples. Take a look at Dollar Tree back during the 2008 meltdown. The entire financial system is on the brink of collapse, but their revenues? They were actually going up. People still needed to buy essentials, and their business model was perfect for the moment. And the stock? It was an absolute monster, a huge outperformer. So, case closed, right? Earnings are king. Well, maybe not.
And this is where we need to zoom out and look at the much bigger picture. Because even though a single great company can do well, the entire market can get dragged down by a force that has absolutely nothing to do with profits.
This right here is the million-dollar question. If most companies are crushing their earnings reports and giving rosy outlooks, why do we still get these brutal market-wide crashes? If earnings were the only thing driving the bus, it wouldn't happen. It tells you we're missing a massive piece of the puzzle.
Let's try an analogy here. In our little financial solar system, think of company earnings as planets. They're big, they have their own gravity, they definitely matter. But they aren't the sun. They aren't the true center of gravity that everything else orbits. That is something else entirely.
And here it is. Just look at this chart. This is the S&P 500 laid right on top of the U.S. Federal Reserve's balance sheet. See that? When the Fed's balance sheet goes up, that's them pumping money or liquidity into the system, the market soars. And when it starts to shrink, the market follows it right down. I mean, it is almost a perfect mirror image. This is not a coincidence, folks. This is the market's true center of gravity.
So how on earth does this work? Let's start with the fun part, the up part of that line. This is a process you've probably heard about called quantitative easing, or just QE.
To put it as simply as possible, QE is when a central bank, like the Fed here in the US, literally creates money out of thin air. They then use that new money to buy financial assets, like government bonds. The whole point is to flood the financial system with cash, which pushes interest rates down and, in theory, encourages people and businesses to borrow and spend.
Now, here's how this abracadabra money printing actually works. First, the Fed says, the economy needs some help. Then, with just a few keystrokes on a computer, they're not literally firing up a printing press, they create brand new digital dollars. They use those new dollars to buy things like treasury bonds from big banks. Now all of a sudden, those banks are sitting on giant piles of cash, and that money has to go somewhere. With interest rates now pushed down to near zero, that cash flows into riskier assets, like stocks.
And the scale of this, it is just hard to comprehend. At its peak, after all the stimulus from the 2008 crisis and then the pandemic, the Fed's balance sheet swelled to nearly $9 trillion. That's a 9 with 12 zeros after it. And the effect of all that cash is predictable. It's like a massive rising tide. It doesn't just lift one or two boats, it lifts everything. Stock prices go up, real estate prices go up, even things like crypto prices get pushed higher. This is the direct, intended consequence of QE. But what happens when the party stops? What happens when that process not only stops but goes into reverse? Well, that's when we meet QE's evil twin, quantitative tightening, or QT. This is the invisible gravity that can silently pull the market down. And the most important thing to get here is that QT is the exact mirror opposite of QE. Instead of injecting liquidity, it's draining it. Instead of buying assets, the Fed just lets the bonds it owns mature and disappear, effectively deleting that money from the system. All of this puts downward pressure on asset prices and tightens the financial screws. And if you're thinking, okay, but how bad can it be? Well, we have a very recent, very painful example. The last time the Fed seriously tried to do this was back in 2018. The result? The market threw a massive tantrum. The S&P 500 plunged almost 18% in just a few months.
The reaction was so bad that it actually forced the Fed to give up and reverse course. That tells you just how powerful this force really is.
Okay, so we get the idea. QE is the gas pedal, QT is the brake. But how can we, as investors, actually see what the Fed is doing in real time? How can we read their playbook before it's too late?
It really all boils down to one of the oldest and truest sayings on Wall Street: don't fight the Fed. Seriously, trying to be a hero and invest against the trend of central bank liquidity, it's probably the fastest way to watch your portfolio bleed out, especially in a tough market.
Now, a key place to watch for signs of this liquidity is something called the repo market. Now, don't let the name scare you. It sounds complicated, but the concept is simple. Think of it as the critical high-stakes plumbing of the entire financial system. It's where big banks lend enormous amounts of money to each other overnight just to make sure the whole system keeps running smoothly. It is absolutely essential.
And inside this giant plumbing network, there's one specific pressure gauge that we can all watch. It's the Fed's Reverse Repo Facility, or RRP. Basically, when banks have way too much cash sloshing around, more than they know what to do with, they can just park it at the Fed overnight for a tiny risk-free profit. So when you see a really high number in the RRP, it's a signal that there's a ton of excess cash in the system.
And the amount of money flowing through this market is it's stunning. We're talking somewhere between $2 and $4 trillion every single day. To put that in perspective, that's more than the entire yearly economic output of a country like Canada, changing hands on a daily basis. That's why when this plumbing gets clogged, the whole system is in big trouble.
So let's tie this all together. What does this all mean for you? Well, it means we kind of have to update our old rule book. The old rules about earnings, they still matter, for sure, but they're operating inside this much larger gravitational field that's controlled by the central banks.
So here's your new macro lens. First, you have to accept that central bank liquidity is probably the primary driver of the overall market. It's the tide that lifts or lowers all the boats. Second, that mantra, don't fight the Fed, you gotta burn it into your brain. Your goal is to invest with the liquidity trend, not against it. Third, you can actually track this stuff. Keep an eye on the Fed's balance sheet and that reverse repo number to see which way the tide is flowing. And finally, just always know what cycle you're in. Is the Fed pumping money in, or are they taking it out? The answer to that question might be more important than any single company's earnings report.
And that really brings us to the final and most critical question you need to ask yourself. For over a decade, we've had this unprecedented tide of money lifting everything up. But when that tide inevitably goes out, which it always does during a QT cycle, you have to ask yourself, which of my investments have just been floating along with the tide? Because as they say, it's only when the tide goes out that you discover who's been swimming naked.